Have you ever wondered why some people become incredibly wealthy through the stock market, while millions of others lose money without ever understanding how the system really works? Most people think the stock market is nothing more than gambling, but the truth is very different from what you have probably been told. If you understand how the stock market really works, you will start seeing businesses, money, and investing in a completely different way. By the end of this video, you will understand why stock prices move, how investors make money, and why patience often beats luck. Let's begin with the biggest misunderstanding that keeps millions of people away from building long-term wealth. Many people believe buying a stock means buying a random number on a screen, but that idea is completely wrong. When you buy a stock, you're actually buying a small ownership share in a real business that sells products or services. Imagine your favorite coffee shop decides to grow and needs money to open more locations across the country. Instead of borrowing all the money from a bank, the business decides to invite ordinary people to become part owners. The company divides its ownership into thousands or even millions of small pieces called shares. Every single share represents a tiny piece of that business, no matter how small your investment may be. If the business grows stronger over time, your ownership can become much more valuable than when you first invested. This is one of the biggest reasons why long-term investors often build far more wealth than short-term traders. Legendary investor Warren Buffett once said, "If you don't find a way to make money while you sleep, you will work until you die." His message was simple, because owning great businesses allows your money to keep working even when you are not. But if owning companies is such a powerful idea, why do stock prices rise one day and fall the very next day? To answer that question, we first need to understand one of the most important forces in every financial market. That powerful force is called supply and demand, and it quietly controls prices almost every single day. Understanding this simple concept will help you see why millions of investors make decisions that move the market every second. Once you understand this foundation, the stock market will no longer feel confusing, and every price movement will start making much more sense. Imagine there are only 100 shares available, but thousands of investors suddenly want to buy them at the same time. When more people want to buy than sell, buyers begin offering higher prices to convince someone to sell. This competition between buyers pushes the stock price higher, even if nothing else changes overnight. Now imagine the opposite situation where investors become afraid and everyone wants to sell at the same time. When sellers greatly outnumber buyers, stock prices usually begin falling very quickly. The business itself may still be healthy, but fear alone can temporarily drive the price lower. This is why experienced investors learn to separate a company's real value from its daily market price. Benjamin Graham called the market a voting machine in the short term and a weighing machine in the long term. His lesson reminds us that emotions influence prices today, but true business performance wins over time. This is exactly why smart investors spend more time studying businesses than watching prices every minute. Another important question is where all these shares are actually bought and sold every single day. The answer is a stock exchange, which acts like a giant marketplace connecting buyers and sellers from around the world. Famous exchanges like the New York Stock Exchange and NASDAQ handle millions of transactions every trading day. Modern technology allows these transactions to happen in just fractions of a second with incredible accuracy. Whenever your order reaches the market, powerful computer systems search for someone willing to trade with you. Once a matching buyer and seller agree on the same price, the trade is completed almost instantly. Behind every successful trade, there is always one person buying and another person selling the exact same share. That means every transaction happens because two different investors believe opposite things about the future. One investor believes the company's future is bright, while the other believes it is the right time to sell. Understanding this simple process helps remove the mystery from the stock market and prepares you to think like a real investor instead of a gambler. Now that you understand how buying and selling works, let's explore what actually causes a company's value to grow over many years. A great company increases its value by earning more money, serving more customers, and continuing to improve its products every year. As profits continue to grow, more investors become interested because they believe the business will be even more valuable in the future. This growing demand for ownership often pushes the company's stock price higher over the long term. However, Successful investing is never just about buying companies with famous names or popular brands. Smart investors spend time understanding how a business earns money, manages its expenses, and plans for future growth before investing. This careful research helps investors make decisions based on facts instead of emotions or exciting headlines. Unfortunately, many beginners do exactly the opposite by chasing stocks that everyone is suddenly talking about. By the time a stock becomes extremely popular, much of the easy profit has often already been made. This is one reason why experienced investors prefer patience over excitement when making investment decisions. Psychologist Daniel Kahneman discovered that people often fear losing money much more than they enjoy making the same amount. This behavior is known as loss aversion, and it influences millions of investment decisions every single day. When prices suddenly fall, fear causes many people to sell their investments at exactly the wrong time. Later, when prices recover and confidence returns, many of those same investors buy back at much higher prices. This emotional cycle repeats again and again because human psychology rarely changes, even when technology does. That is why successful investors train themselves to stay calm when everyone else is reacting emotionally. Instead of following the crowd, they focus on whether the business itself is becoming stronger over time. This simple habit separates disciplined investors from people who constantly chase short-term market excitement. The stock market rewards knowledge, patience, and consistency much more often than speed or lucky guesses. Professional investors rarely buy a stock because someone on social media says it will make people rich overnight. Instead, they spend hours reading company reports to understand how the business really earns its money. They carefully study the company's revenue, profits, debt, and future plans before making a single investment decision. Every successful investment begins with understanding the business instead of simply following market excitement. Warren Buffett believes you should only invest in businesses that you can easily understand and confidently explain to someone else. That simple rule helps investors avoid confusing companies with risky business models they do not truly understand. Another important habit of successful investors is spreading their money across different companies instead of risking everything on one investment. This strategy is called diversification, and it helps reduce risk when one company performs poorly. Even if one investment struggles, the success of other businesses can help balance your overall portfolio. Professional investors understand that protecting their money is just as important as growing it over time. Many beginners focus only on how much profit they can make without thinking about how much they could lose. Successful investing is not about predicting the future perfectly, but about making smart decisions with the information available today. That is why experienced investors remain patient, even when the market becomes unpredictable for weeks or months. History has shown that strong businesses usually recover from temporary market downturns given enough time. Every major market crash has taught investors that fear eventually fades, but quality businesses continue creating value for years. This is why many wealthy investors continue buying great companies, even when headlines sound negative and frightening. They know the temporary emotions often create opportunities for patient people who think long-term. The biggest advantage in investing is often not having more money but having more patience than everyone else. When you stop treating the stock market like a casino, you begin thinking like a true business owner. With the right knowledge, discipline, and long-term mindset, the stock market can become one of the most powerful tools for building lasting wealth. The biggest mistake people make is believing that successful investing is about finding one perfect stock instead of following a smart long-term strategy. Building wealth through the stock market is usually a slow journey made up of many good decisions repeated over many years. Small investments made consistently can grow into surprisingly large amounts because of the power of compounding. Albert Einstein is often credited with saying that compound interest is the eighth wonder of the world because of its incredible long-term power. The longer your money stays invested in quality businesses, the harder it can work for you without requiring constant attention. Trying to predict every market movement often creates more stress than better investment results. Patient investors understand that temporary market swings are a normal part of the journey toward long-term financial growth. Every experienced investor knows that fear and excitement come and go, but strong businesses continue creating value over time. Instead of asking which stock will double tomorrow, ask which business will still be successful 10 years from now. That single change in thinking can completely transform the way you make investment decisions for the rest of your life. The stock market is not designed to reward the smartest person in the room, but the person who remains disciplined through every market cycle. The habits you build today will have a much greater impact on your future wealth than any single investment decision. Reading, learning, and staying curious will always give you a stronger advantage than blindly following market rumors. Every successful investor started as a beginner who simply decided to keep learning instead of giving up. The knowledge you gain today can continue helping you make better financial decisions for decades to come. Remember that every great investor has experienced mistakes, but they use those lessons to become wiser instead of quitting. Success in the stock market comes from making more good decisions than bad ones and allowing time to do the rest. If you continue studying great businesses and controlling your emotions, you will already be ahead of most investors. The stock market may look complicated at first, but once you understand the fundamentals, it becomes a powerful tool for creating financial freedom. Always remember that the goal is not to get rich quickly, but to build lasting wealth by owning great businesses and staying patient through every stage of the journey. Before you invest your first dollar, you should understand one important fact that many beginners completely ignore about the stock market. Every investment carries some level of risk, but understanding that risk helps you make much smarter financial decisions. Risk does not always mean losing money, because sometimes the biggest risk is never investing at all. Money that sits idle for many years slowly loses purchasing power because inflation quietly reduces its value. That is why many investors choose to own growing businesses instead of letting all their savings remain in cash. A successful investor understands that short-term price movements matter much less than long-term business performance. This mindset allows investors to stay calm during difficult times instead of making emotional decisions they later regret. Professional investors know that temporary market declines often create opportunities to buy great businesses at better prices. Instead of fearing every market correction, experienced investors often prepare for them well in advance. Preparation gives investors confidence because they already know what actions they will take before emotions appear. Creating a simple investment plan is often more valuable than constantly searching for the next hot stock. Your investment plan should match your personal goals, your financial situation, and the amount of risk you can comfortably accept. There is no perfect investment strategy that works for everyone because every person's financial journey is different. The best strategy is the one you can continue following with confidence through both good markets and difficult markets. Financial success usually belongs to people who stay consistent even when progress feels slow at the beginning. Every small investment you make today has the potential to become much more valuable if you give it enough time to grow. The stock market rewards discipline much more often than intelligence because emotions can easily defeat even the smartest investors. If you continue learning and improving your investment knowledge every year, your confidence will naturally continue growing as well. Remember that every successful investor once stood exactly where you are today before gaining experience through learning and patience. Now you understand how the stock market really works, and you have the knowledge to begin thinking like an informed investor instead of simply following the crowd. Now that you understand the basics, let's look at one powerful habit that separates ordinary investors from people who build real wealth over decades. Wealthy investors do not spend every day worrying about market prices because they focus on the long-term growth of great businesses. They understand that daily market movements are often driven by emotions, but business growth is driven by real performance. Companies that continue increasing their sales and profits usually create more value for shareholders over many years. That is why experienced investors spend more time studying business fundamentals than predicting tomorrow's stock price. Another important lesson is is that even the greatest investors are not right every single time they invest. The difference is that successful investors learn from their mistakes instead of allowing those mistakes to stop them completely. Every mistake becomes a valuable lesson that improves future investment decisions when you are willing to keep learning. This mindset of continuous improvement is one reason many successful investors outperform the average person over time. Instead of asking how quickly they can become rich, they ask how they can continue making better decisions every single year. Good investing is much more about controlling your behavior than trying to predict what the market will do tomorrow. The market will always experience periods of fear, excitement, optimism, and uncertainty because human emotions never disappear. Understanding these emotional cycles allows disciplined investors to avoid making expensive decisions during stressful moments. The more knowledge you gain, the less likely you are to panic when prices suddenly move in unexpected directions. Knowledge replaces fear because understanding gives you confidence during uncertain market conditions. Every successful investing journey begins with a single decision to start learning instead of waiting for the perfect moment. The perfect time to begin rarely exists because markets are always changing and presenting new opportunities. What truly matters is building the habit of investing consistently instead of trying to perfectly time the market. Consistent investing allows time and compounding to work together in your favor for many years. The stock market has created wealth for generations of patient investors who understood this simple but powerful principle. Always remember that investing is a marathon, not a sprint, and lasting success comes from patience rather than speed. The investors who stay disciplined during difficult times are often the ones who enjoy the greatest rewards later. Every market downturn eventually becomes part of history, but strong businesses continue moving forward. The greatest advantage you can develop is the ability to remain calm when everyone else is making emotional decisions. When you combine patience, knowledge, discipline, and consistency, you give yourself the best possible chance of building lasting financial freedom through investing. From this moment forward, every investment decision you make should be based on careful thinking instead of temporary emotions. The more you practice disciplined investing, the more confident and experienced you will become with every passing year. Remember that the stock market rewards people who continue learning, adapting, and staying patient through every challenge. Every successful investor was once a beginner who decided that learning about money was worth the effort and the time. You now understand how the stock market really works, and this knowledge can become the first step toward making smarter financial decisions for the rest of your life. If you enjoyed this video and learned something valuable today, subscribe to the channel and turn on notifications so you never miss our next video about investing, money, and financial psychology.